Markets are on a roller coaster. Tariffs are tightening, investors are scrambling, and interest rates are holding steady. But what does this mean for your portfolio? So let's break this down and figure out where the smart money is going. With that, let's jump in. In this video, there are three key things that you're going to be learning. First, we're going to be talking about how rising interest rates could impact the stock market and also your investments. Second, we're going to be talking about why gold is hitting record highs and what it signals about economic uncertainty. And then finally, we're going to be talking about strategies to navigate market volatility, and then how can you actually position your portfolio for the long-term success. I got some really cool charts there, so make sure you stay tuned. So why should you listen to me? Why Fiona? A couple of reasons. First, I've helped 453 millionaires build wealth. I became a millionaire myself at 27 with the same strategies. In other words, I practice what I preach. I went to Harvard and MIT, and I also studied 11,000 hours finance, and not to mention the 7 years that I spent in wealth management. So before we jump in, make sure that you like and subscribe to my channel. I would really appreciate it. All right, let's jump in. So the interest rate surge. Let's talk about what this actually means. What are interest rates and how do interest rates impact your personal financial portfolio? So I wanted to show you this chart. I thought this was really interesting because it shows two things. It shows what the Federal Reserve does with its rates, and it also shows how the S&P 500 responds to rate increases or rate cuts, which are rate decreases. So you can see two lines here. You'll see the red line and you'll see the black line. I feel like I'm in the Matrix, where they say you have the red pill and you have the blue pill. Here you have the red line and you have the black line. So the red line represents the S&P 500 and the black line represents the fund rate. So how much do they effectively go up or down? And what you can see is, at least since the 1990s, there's really been this divergence where the S&P 500 has just pretty much rallied, even though there have been ups and downs, like the great financial crisis here in 2008, which you'll see here. You'll see, of course, 2020, the COVID crisis, but overall, it has been going fairly well, the stock market, the S&P 500. What's the biggest takeaway I see in this chart? The first thing is, if you look here, interest rates have been historically quite low. That means that the Fed hasn't really bumped up the interest rates. They're trying to stimulate the economy. Why during this time period? Well, if you look here in this gray area, you see the great financial crisis. So, of course, the economy was very slow and the Fed wanted to stimulate it. They wanted to get people putting money back into businesses, to buy houses, to buy cars and whatnot. So what do? You basically decrease the cost of borrowing, right? So cost of borrowing essentially means you got mortgages, you got student loans, you got car debt, all of that. Well, if these interest rates are low, like you see here from 2010 to 2018-ish, people are starting to think, oh, debt is cheap. I'm going to go out and I'm going to borrow stuff. I'm going to borrow money to buy houses, to buy cars, etc., etc. So what does that mean? It stimulates the economy. So you can see while these interest rates are low, commensurately, if you look here, the red line, the S&P 500, it's rallying. The trend is actually quite good. It's going upward. The trend is up, and that's what we like. So we can see that when interest rates are low in general, the economy is stimulated. That's the key takeaway here from this graph. And when interest rates go up, they're trying to cool down the economy. The economy is maybe overheating. In other words, there's this thing called inflation that I know a lot of us really don't like. At least I don't like it. So if there's inflation, what are they trying to do? They will increase interest rates. And this makes sense because in 2022, interest rates saw an all-time high, not an all-time high, but at least in recent decades high of 9%. So what were they trying to do? The Fed, they tried to lower inflation, which they did relatively, and they increased interest rates. Increase interest rates, lower inflation. That's how it works. However, how does that impact the stock market, the S&P 500? Well, you can see here when interest rates were increased in 2022, guess what? We saw quite a bit of stock market volatility at the same time. So if you can take away something, I'm going to move on here to the left-hand side. If we increase interest rates, okay, that means that there will likely be decreased inflation, but at the same time, there's also going to be increased stock market volatility, right? I'm just going to say stock volatility. And then on the flip side, if we decrease interest rates, or at least if we keep them pretty low, in fact, during this time, if we take a look back here, from 2010 to 2014, and even after COVID here during this period, interest rates were actually at pretty much all-time lows. So pretty interesting to know. Anyway, so going back here, low interest rates, let me zoom out here quickly so you can see the full thing. Low interest rates typically means increased economic, how do you call it? Economic mobility, maybe? Economic stimulation is another good word. So probably stimulation is better than mobility. So you have increased stimulation in the economy because the borrowing costs, so it's cheap debt, right? So you have cheaper debt, which then causes this increased economic stimulation. And it also increases the stock market rally, meaning the stock market goes up. So that's exactly what this means. So now you can see, at least in a very large, high-level view, what the difference is if you have, one, increased interest rates, and then two, decreased interest rates, and what the impact is on the overall economy. And I should also say that this actually makes debt more expensive, right? So your mortgage interest rates, for example, during this time here from 2010 to 2014, and even now from just after the COVID crisis, interest rates were at like 3% for mortgages, right? For a 30-year mortgage, it was pretty low. And that's when I refinanced my house as well. When the Fed increased its rates in 2022 to combat inflation here, that was at about 9%. Well, guess what? Mortgage rates also shot up commensurately, meaning, if you remember back to a few years ago, mortgage rates were between 7 to 9% for a 30-year mortgage, and that slowed down the economy. In other words, people were not going out and getting mortgages to buy homes. So that is the overall impact, just on a very high level view. So with that, I wanted to also show you the overlap between how the Fed, whenever it increases its interest rate, or also the funds that the Fed has, versus how the S&P 500 changes in performance, in annualized performance. So the yellow bar is the S&P 500, and the blue bar is, or the blue line rather, is the Fed funds. How much in funds does the Fed have? So the Fed is really responsible for maintaining the overall monetary policy, right, for the overall US. They have a lot of impact on banks. They have a lot of impact on the overall stock market in general because of these trickle-down effects. So take a look here. Whenever the Fed funds decreases, what happens? The stock market also decreases or has a negative return. So as you can see, the Fed really does signal how much confidence there is in the overall economy. As the funds, like as the actual funds, the monetary value in the funds decreases for the Fed, well then investors also think, maybe this is a slowdown in the economy, and thus the stock market, or it at least changes for the negative. And that kind of makes sense, right? For example, this decrease in funds correlates with the dot-com bubble. What happened? The Fed, they wanted to push funds into the economy to boost the economy, to stimulate the economy. Thus, the funds actually decreased, which also showed, again, the economy isn't doing that well. I mean, you didn't need to know this in order to know the economy wasn't going well. But again, it's just another signal, and thus the S&P 500 did not have good returns. Likewise, in the Great Financial Crisis, in order to stimulate the economy, the Fed pushed funds into the economy, and of course, commensurately, the S&P 500 decreased, so had negative returns. So in 2020, that was a little bit different. Yes, the funds were pushed into the economy, but it was such a short time frame. In 2020, the COVID crisis was very different from previous recessions. So I wouldn't necessarily use that calculus into my overall understanding of how the Fed fund versus the S&P 500 reacts. Another thing I wanted to show you was the US Fed fund rate, so we're looking back at the rate versus the S&P 500. So again, we're looking at two specific lines. One is the red, which is the rate. So how high is the rate of the Federal Reserve, the interest rate essentially, versus the S&P 500, which is the blue line, right? So how well is the stock market going? As you can see, again, this chart is just a different way of seeing this chart, right? So there are two different ways of viewing the same thing, essentially. As you can see, as this is low, as I showed you before, we see a massive rally in the stock market. The second the fund rate goes up, we see a decrease, right? We see that the stock market starts cooling down, the economy cools down. And that is also the same here from the great financial crisis. As the rates were kept low, we could see that the overall trend was generally high. The second the rates go up, we see this volatility in the stock market. This is a repeat rhythm, if you will. All right, moving on. How does this future look like? So what does the actual Fed future look like? So there is actually a really interesting website that I recommend that you check out. It's free for anyone. It's the CME group, and it essentially watches the Fed. In other words, it checks out and it predicts using a lot of data and polling to understand what the Fed will do with its next meeting. So the Fed meets a couple of times each year and then decides, hey, do we hike the rates and then potentially cause stock market volatility, or do we cut the rates and then maybe cause more growth in the stock market, right? So those are the two thought processes. Or do I keep the rates steady for now and not change them at all? And this group here, it essentially tracks whenever the next meeting is. In this case, at the time that I took the screenshot, the next meeting was 13 days away. And you can see that it has this thing called the Fed Watch tool. Again, it's free for anyone. So if you want to check this out after this video, make sure you do so. And you can see how right now what the actual guess is. So this says the current target rate, 94%, is a 4.25 to 4.5% potential rate. Like, this is where it will likely be. Right now it is at 4.5% anyway. So what this is saying is there's a really high chance of no change. So you just have to know, where are the rates currently? They're at 4.5%. And so this here is in basis points. So as you can see, BPS, basis points. And so instead of saying 4.5%, it just converts it to 450 basis points, which is the same thing as 4.5%, right? So you just have to know that right now the rates are at 4.5%. And so thus the 94% means that there's pretty much a high probability of no change in the overall rate, the interest rate for the Fed. So what does this mean for you? The interest rates, they rose to 4.5% in 2025, and chances are that they're going to stay the same, right? So we literally just saw that in this chart here. The chances are it's going to stay the same. There's not going to be a difference, which means there's probably not going to be that much of stock market volatility. Historically, higher rates can suppress stock valuation. So again, think back to the chart, or at least the quick drawing I made here, where I talked about higher interest rates. They actually kind of increase stock market volatility, which ultimately causes the stocks to go down. That's what this means. It causes the stocks to be suppressed. In other words, lower value. And then finally, number 3, the S&P 500 has shown mixed reactions to rate hikes. Typically, rate hikes does cause volatility in some way, shape, or form, but sometimes the S&P 500 doesn't always follow the pattern and actually rally. So again, you just have to kind of take it with a grain of salt, understand what it means, and then, just make sure you keep investing. Don't change your investing pattern just because of this. How is the economy impacted by interest rate shifts? Again, I wanted to give you 3 key points here. Higher rates equals costlier borrowing, which is what we spoke about earlier for companies and people. This means that investors might shift from stocks to bonds. Why? Because they want stability. That is the key. Bonds offer stability. If there are higher rates, stock market shows volatility, and many investors don't want to see that volatility, which is why they move to bonds. And then potential slowdown in economic growth. Well, we saw that as well, right? There's a slowdown in economic growth because there is a lot of volatility. If there is a lot of volatility, investors move to stocks and bonds, which causes a slowdown. So it really is it's a repeating cycle, right? Okay, so moving on, let's actually talk about gold. I think gold is really interesting, and gold actually has a pretty good grasp on where the economy is heading. So let's check it out. There's a recent rally. Check this out. Look at this. We are at literal all-time highs for gold, and this here is the maximum I could possibly do at 20 years. So according to this chart, you can see that the actual value, the US dollar per kilogram of gold has reached $105,000 at the time of this chart screenshot. So who knows, maybe by the time you're watching this video, it might have changed quite significantly. I also wanted to show you how gold changes with the S&P 500. So this I thought was interesting, where you see the S&P 500 in blue, gold in gold, and you can see, generally speaking, there's an inverse correlation. Okay, so this is inversely correlated, which is exactly why people or investors tend to flock to gold during recessions. Why? Because when the S&P 500 is down, so for example, during COVID, we're seeing negative returns. Well, what happens to gold? Look at this. This here's how low the S&P 500 is. Look where gold is. Gold is actually doing pretty well. Like, it's in positive territory, right? This here is 0% return. We're looking at negative returns from the S&P 500. For gold, we're looking at somewhere about 30% returns. So quite a significant difference. So whenever the S&P 500 is not doing well, typically gold does well. And when the S&P 500 is doing very well, like it's rallying like it did in 2022, well, gold isn't negative, but it's not doing as well in terms of returns as the S&P 500. And this difference is called the spread, right? So there is a spread. If there is a positive spread for gold, that means gold is doing better. If there's a negative spread for gold, that means gold is not doing as well as the S&P 500. And you can see once again, if I'm going to zoom in here, the S&P 500 is not doing too hot, at least at the time of this image. And for that, gold ended up doing very well. So again, there's this spread where gold actually is outperforming the S&P 500. So it's inversely correlated. That's what this image means. And then here's another image I wanted to show you, gold versus inflation. And once again, you can see that CPI, which is the Consumer Price Index, also known as inflation, whenever the blue line spikes up, generally gold keeps pace. So that's what this chart is showing, that gold in general can keep pace with inflation. You can see that, inflation actually is much less than gold. So gold actually outpaced inflation here in 2023, which is good. This is exactly what investors wanted. They flock to gold when there is inflation because typically the price of gold can keep pace or outperform inflation. And that's also what this chart shows. Okay, so let's move actually back to the key points here. Gold surged over $3,500 per ounce in 2025. What does this mean? It means, and this goes directly to point number 2, it means that investors, they flock to gold because they're really scared about what's going on in the economy. They have fears about inflation and specifically instability in the economy. So whenever the economy is unstable, think back to the image where I showed you the inverse correlation of the S&P 500 and gold. Well, if the S&P 500 isn't doing well because the economy isn't doing well, people go to gold. And then finally, central banks, they're also increasing their gold reserves. So the US has a handful of central banks around the country. For example, there's one in St. Louis, there's one in New York. And these central banks, I wanted to kind of show you, actually, we're going to look at point number 3 here. So we're going to skip to point 3. If they buy gold, that means it actually bolsters the demand of you and me, of the investor, because it's a signal of confidence in the central bank, which actually have quite a bit of power in the US at least, that they believe that gold has a really good long-term value. So if they buy gold, that means that they might expect short-term volatility, and so they're buying gold because they want long-term growth in the price of gold. And if the central banks actually buy gold, that means that there's reduced market supply, right? Like if you buy a Lamborghini, that means there's one less Lamborghini out in the market, which means the value probably goes up. That's, very high picture. If there's less of something, that means the price probably goes up and the demand goes up. And that's why the prices increase. So if the central bank buys gold, prices typically increase. And it also means that the central banks actually want to reduce reliance on the US dollar, which means maybe the US dollar is a little bit shaky. They want to diversify their holdings, so thus they go into gold. So that's what I meant by central banks buying gold. The other 2 points here for gold in the economy are, again, one, investors flock to gold in market uncertainty. So that's because gold is really a type of safe haven. Because it retains value. And we saw that in the charts we looked at, right? It keeps its value when stocks and currencies like the US dollar go up and down. So investors really like the stability of gold when there's financial turmoil. It's also an inflation hedge, which is what we just looked at in the chart. So gold typically preserves its purchasing power during inflation. We saw in this chart here that gold generally keeps track with inflation, right? So typically it still keeps its purchasing power. And that's really unlike the dollar. So dollar is the same thing as fiat currency. And generally speaking, and we've seen this over the last several decades, when inflation goes up, then that means the purchasing power of the dollar goes down. I'm just going to say dollar PP for purchasing power. So we have seen that, and that really holds true. For gold, that's not necessarily the case. And then finally, there's really no counterparty risk, which means unlike bank deposits, gold isn't really dependent on the third party solvency. This, you can take it with a grain of salt because banks, they do have something called FDIC insurance, and that's typically up to $250,000 per account holder. And so what does that mean? That means if the bank no longer is solvent, meaning they don't have the funds, the money to pay your cash deposit in the bank, then this Federal Deposit Insurance Corporation, the FDIC, steps in. It's literally an insurance from the federal, basically from the federal piece from the country, and they essentially pay you out up to $250,000 in cash in your bank account per account holder, which means if you are a joint account holder, that means you actually can get up to $500,000 in FDIC insurance. So if you have $500,000 in your bank account, wouldn't we all want that? Then, and the bank goes under, you'll still get paid out. So that's what this means. Gold, I actually think, has more risk. This year is a known rough benefit, but I do just want to point that out. Gold generally does not have FDIC insurance, so you're not that secure. This here refers to more if you actually have the physical gold on your hand. So that's what it means. Like if you have physical gold, yeah, you don't have to run to a bank and worry that your money is gone. But for that, you also have to worry like, hey, what if someone steals my gold? Do I put it in a safety deposit box? Do I put it into a safe in my house? How do I protect it? So these are all concerns that are very unique to gold. And then typically gold does outperform during inflationary periods. We already talked about that. So other precious metals, I thought I might just briefly show you how other precious metals are doing. So this here is silver. Again, not as much as gold. We're looking at 33.61 US dollars per kilogram. Here we're looking at $975 per kilogram for platinum. So just wanted to show you the difference between gold and these two other precious metals. So clearly gold is a winner, at least if we're looking at the US dollar value per kilogram. So next up, let's look at tariffs and trade tensions. I think the key point of this chart that I wanted to show is that whenever there is a tariff, then the stock market indices of each country, so in the US, that's the S&P 500, for example. In the UK, that's the FTSE 100. You got the Shanghai Composite in China and so on. It does decrease. So you can see that overall, there are negative returns at least at the time of this chart, right? Because of tariffs. So tariffs really hurt a majority of countries. As you can see here, it's really hurt the US. It's also really hurt China, at least with their index. So it's not always a good story. So tariffs can really hurt the economy and ultimately your portfolio positions. So the key points here are new tariffs disrupted global trade in general. It didn't just hurt the US, it didn't just hurt China, it really did hurt. It had a trickle effect for the rest of the world. Certain sectors are more impacted than others. We kind of have seen this already with the automotive industry, right? So those tariffs, consumer goods because of increased operating costs, and then agriculture and food and beverage. Generally, these are impacts on like soybeans, pork, dairy, and then alcohol and other specialty foods. Those are the ones that really felt the pain on the tariffs. And then also market volatility increases with trade policy shifts, which makes sense. So tariffs and the economy. So tariffs increase costs for importers and exporters. That's why the costs are passed down to the consumer, you and me, which means we don't have enough money to generally invest in the stock market, which means that also can cause stock market volatility, which is what we have seen in recent times. Supply chain disruptions affect company earnings. That can absolutely take place when you have tariffs imposed on outside of the US countries, and thus the supply chain, which is not always in the US, can be impacted. So there's an increased cost, which again will be brought down to the consumer. And then investor confidence is typically shaken by policy unpredictability. Humans, they are creatures of habit, right? We don't really like unpredictable change, which is right now what has been happening with tariffs. And sometimes, that confidence can be shaken, which means investors move from the stock market to the bond market, which is what we've seen before. So how do you navigate this market volatility? Again, I think you can see that after every single, so I'm going to zoom into this chart. And again, know that the gray line shows a recession. And after every single recession, the market has gone up. Now, of course, the question is, how long does it take for the market to actually rebound? It can take time. It can take a lot of time, in fact. So for example, from the great financial crisis to get back to the same peak, it took about almost 10 years, maybe 8 years for it to come back to the same peak. However, the point is it did come back. The market so far has always rebounded, right? And that is something I can say. It took, for example, this period, it did take a long time as well. It took, 30 years basically? Maybe a little bit less, but it does take time. The amount of time that it takes to rebound to the previous peak before a recession, that varies. But generally speaking, you do see some sort of return in the stock market, pretty much almost always. And I should probably rephrase, this here is more like 20 years or something like that, 15 years. But still, 15 years is a long time to rebound. Okay, so let's talk about the key points here. The market recovers from past downturns pretty much all the time. At least so far in history, it's always recovered. Long-term investing mitigates short-term volatility, and diversification is absolute key to managing risk. I actually have a chart here in a second that I want to show you about this key to managing risk with diversification. And then it's important to rebalance your portfolio periodically. For me, that means every single quarter. But other folks might want to do it every single month, every week. I highly don't recommend you to do it every single day because that can cause a lot of stress too, in my opinion. So let's look at some actionable insights. What can you do right now given the market conditions and the economic conditions? So first, you can balance your portfolios, or balanced portfolios can perform better during uncertainty, and I'll show you what that means. What does actually balanced mean? I'll show you in a second. Incorporating alt assets can reduce risk. I'll show you that in a second. Alternative assets essentially means stuff like real estate. It could mean cryptocurrency. It could mean real estate investment trusts, which are also relatively alternative. It could mean precious metals like gold, what we just discussed. It could mean a variety of factors. It's important to review your portfolio regularly and then diversify. So below are some examples. Some diversification aspects could include defensive sectors. They'll likely do well. Gold or bonds for more stability if that's what you're looking for. And then make sure you maintain some liquidity like cash. So you can have your cash in things called money market funds. You can have your cash in things called high yield savings accounts and things of that nature. But it's important to have some sort of liquidity in case you need to pay off debt or have some sort of emergency, right? So like an unexpected vet bill, for example. And this chart, I think, does a really good job showing how important it is to diversify your portfolio with alternative assets. So again, we spoke about what alternative assets are. So I want you to look at the bottom, this x-axis, which shows the volatility, and then the y-axis here, which shows the annualized returns, right? And the two differences, you can see if we are looking at a relatively aggressive portfolio, 80% in stocks, 20% in bonds, and nothing in alts, the volatility, so the further out it is this way, it means it's actually pretty high in risk. So volatility and risk is pretty similar. But if you add 30% of alternatives, it actually decreases the risk, it increases the return, and you can see that by the given Sharpe ratio. So you can see that this original Sharpe ratio was 0.48, and here the Sharpe ratio is 0.67. So the Sharpe ratio increased. The higher the Sharpe ratio, the better. Sharpe ratios, this here is more of an investing term. It essentially means how much extra return do you get? So how much more money do you get per unit of risk, like per increased risk that you take? So obviously we want to get a higher return, and the higher the better. And that means a higher Sharpe ratio is better. And you can see this also here with this image. If you have this portfolio, which is generally considered a balanced portfolio, which means it's a 60-40 portfolio, 60% of your money is in stocks, 40% of your money is in bonds. And this portfolio has a Sharpe ratio of 0.55. And if you put alternatives, 30% alternatives into the same portfolio, then your Sharpe ratio actually goes up to 0.75. So again, that means you have less risk, but you have a higher return. So that is what it means. And the same thing goes for this pretty conservative portfolio because it has a low number of equities, low exposure to stocks. So that's what this chart means. The more you diversify, you don't have to put your money into alts. That's not necessary. But the point is it's important to diversify, right? You don't just want to put your money into one stock, one bond, or just in cash. This is what this chart shows. Okay, so the most important thing is to start building wealth right now. And I don't know where the TH went. It's important to start building wealth right now. So if you found this video helpful, please make sure that you like and share to help others. And also subscribe to my YouTube channel. It's _MMW for more cool insights. And then make sure you join my newsletter for more exclusive tips. The link is in the description below. Your bank accounts will thank you later. Thanks, guys.